jumping straight into NextNRG today. Everyone is watching the price action, but the real story is the explosive 253% revenue growth.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And hey, before we start unpacking the insanity of those numbers, do us a favor, subscribe and hit the like button. Our goal is to simplify this complex market for as many listeners as possible, and you hitting that button helps us do exactly that.
It really does.
Okay, so let's get into it. NextNRG. If you pull up the chart right now, February 5th, you see a stock trading near, what, $1.12?
Yeah, around there.
And you see it bouncing around like a pinball. It's been between 93 cents and over $4 in the last year.
It looks, for all intents and purposes, like a classic, very volatile penny stock.
It really does. But then you crack open the hood, you look at the engine, and you see a revenue trajectory that just... it doesn't make any sense for a company this size. It feels like a glitch in the matrix.
It is a study in contrast.
Yeah.
I mean, usually when we look at companies trading in this price range, around that $1 mark, we are looking at, distressed assets.
Right, companies on their last legs.
Exactly.
Yeah.
Trying to restructure debt, maybe hoping for some miracle buyout to save them. But here,
Yeah.
we're looking at a growth curve that would make a Silicon Valley software startup jealous.
You mentioned the 253% number right at the top. I want to pause on that because numbers like that get thrown around in press releases all the time.
Sure.
And usually there's an asterisk the size of a planet next to it. Is that real organic growth, or is it some kind of accounting gymnastics?
No, that's the real deal.
Yeah.
And we need to contextualize it to really understand why the market is starting to pay attention. That isn't a cumulative number over 5 years.
Okay.
That is year-over-year growth. Recorded in their preliminary results for December 2025, they essentially tripled their revenue compared to the same time last year.
It's massive. And looking at the data, it's not a one-off fluke either. That's what caught my eye.
It's a trend.
Yeah, if you look at the trend line leading up to that, April 2025, up 154%. February 2025, up 139%. They are consistently stacking triple-digit growth.
They're compounding. That's the key.
Well, we are talking about a trailing 12-month revenue now sitting at $65.62 million.
And compare that to 2024, where they were sitting at roughly $27 million.
So they've more than doubled the entire business in a window where most companies are just fighting to beat inflation. And that begs the question, how? What are they actually selling? Because energy it's such a broad term.
Sure, you have these old guard utility companies, huge lumbering giants that are lucky to grow 2% a year. They're the tortoises. NextNRG is definitely running like a hare.
So are they selling electrons? Are they selling software? Because when I hear NextNRG, I just assume they're another utility provider sending me a bill.
And that's the big misconception.
Yeah.
NextNRG isn't just selling electrons. They're selling a platform. This is what we call the AI energy play. They've successfully pivoted into a business mix that combines mobile fuel delivery, battery storage, wireless EV charging, and microgrids.
Okay, hold on. Mobile fuel delivery. That sounds, well, frankly, it sounds like Uber Eats for diesel. Is that what we're talking about?
On the surface, yes. A guy in a truck shows up to fill a generator.
Because that doesn't sound like high-tech AI to me. That sounds like logistics.
Right, but if you think about it like ordering a pizza for your gas tank, you miss the actual value prop. Think about a construction site, or a fleet of delivery trucks, or a data center.
Okay.
If their equipment runs dry, they stop working. Downtime costs thousands of dollars an hour. The moat, the competitive advantage, isn't the truck itself, it's the logistics platform. It's the AI and machine learning that optimizes those routes.
So it's the brain, not the brawn.
Precisely. They're using data to make energy delivery more efficient than anyone else can manage. They know when a customer needs fuel before the customer even checks the gauge. They route the trucks to minimize idle time and fuel burn. That is why you see those revenue numbers exploding. They are scaling the service so rapidly because the software allows them to add customers without breaking the whole chain.
So they're applying big tech efficiency to old world dirty jobs. That makes sense for the revenue explosion, but let's play devil's advocate here.
Please.
Logistics is a brutal low margin game. You're fighting for pennies on every gallon delivered. Is this sustainable?
That's a fair critique. And if they were only doing fuel delivery, I'd be worried about the long-term margins too. But the piece that I think is even more fascinating, the thing that separates them from just being a trucking company, is the microgrid side of the business.
Here's where it gets really interesting. The microgrids. This isn't just filling up a tank. This is building infrastructure.
Real hard assets.
Yeah, I was reading through the recent filings, and my jaw hit the floor on this one specific detail. They just locked in a 28-year power purchase agreement, a PPA, with a healthcare facility in California.
28
Yeah.
years.
28 years. I mean, in this market, getting a contract that lasts longer than a mortgage is unheard of. Most tech contracts are, 12 months, 3 years max?
Right.
Why would a client lock themselves in for 3 decades?
It is a massive validation of their technology. And you have to think about who the client is here. This isn't a shopping mall or a generic office park. It's a healthcare facility.
Hospitals, medical centers, they cannot afford power outages, period.
Never. If the grid goes down, which, let's be honest, in California it happens, they need instantaneous, reliable backup.
Lives are literally on the line.
Correct. So by signing a 28-year deal, this facility is effectively saying, we trust your microgrid technology, your solar, your batteries, your control systems, to keep our life-saving equipment running for the next 3 decades.
That is what we call a sticky contract.
Sticky. That's super glue. You don't rip that out.
No way.
And it proves NextNRG can enter the multi-billion-dollar healthcare market, which is notoriously difficult to penetrate. The barrier to entry is massive. You can't just be a startup with a cool PowerPoint deck.
You need proven tech that won't fail when the lights go out, and that's the moat right there. Once you install a microgrid at a hospital, they aren't going to switch providers next year because someone offered a slightly cheaper rate.
It's mission critical. It's bolted to the ground. So look at the business mix now. You have this explosive transactional revenue from the mobile fueling, that's the cash flow engine, and then layered underneath, you have this bedrock of long-term stability building up from the microgrids.
It's a compelling mix, and the market, or at least the analysts, seems to be waking up to it.
They are.
Now, standard disclaimer, we don't do specific buy or sell ratings here. We're not financial advisors, but we can look at the targets that are out there.
On the street, yeah.
Analysts have revised their targets upward. They're eyeing a potential move toward $5.50. Now, just do the math on that for a second.
I know you already did the math. You love the calculator.
I absolutely did. If the stock is trading around $1.12 today and it goes to $5.50, that is roughly a 366% upside.
That's the kind of potential trajectory that gets people's attention.
And that upside is why you are seeing what we call institutional logic kicking in. The smart money, they're always looking for an asymmetry.
A situation where the potential reward just vastly outweighs the perceived risk.
Exactly. They look at the shift toward decentralized energy grids, which is a macro trend we can't ignore. The centralized grid is old, it's brittle.
It's overloaded. The world is moving to local generation. They see a company that seems undervalued relative to its growth rate. The market cap is only around $162 million.
For a company generating this kind of growth and holding 30-year contracts, a lot of institutional investors are starting to ask if this is mispriced. It sounds perfect, doesn't it?
It does.
Triple-digit growth, AI tech, 30-year contracts, massive upside. But we are the easy money show, and we have to keep it real. There is a reason the stock is $1.12 and not $50. There is a catch.
There's always a catch.
Let's break that down even further, because you're right, the market is rarely wrong for long, and there is a very heavy anchor dragging on this ship.
And that anchor is profitability.
Yes. I looked at the income statement, and the numbers are ugly when you get to the bottom line. It's just a sea of red ink.
It is. While revenue is shooting to the moon, they are losing money hand over fist. Net income for the trailing 12 months is negative $57.07 million.
Negative $57 million. That is almost $1 million a week in losses.
And even worse, look at the EPS. Their earnings per share is negative 3.71. Think about that. For every share you own, a share that costs you $1.12, the company effectively lost nearly $4.
That is a terrifying ratio. So what does this all mean? They're bringing in $65 million in revenue, but losing $57 million. That burn rate is intense. Why? Is the business model broken?
It's not necessarily broken, but it is expensive. It's the classic growth strategy or growth trap, depending on your perspective.
Right.
They're in a heavy investment phase. This isn't software where you just copy code and sell it a million times for zero marginal cost. Building microgrids requires massive upfront capital. Solar panels, batteries, inverters, that stuff costs real money.
And the trucks for the fuel delivery, you can't just download a truck.
Exactly. Expanding a mobile fuel fleet requires buying tankers, hiring drivers, developing that platform. They are spending cash to capture market share. The bet is that once the infrastructure is in place, the costs will stabilize.
Scale first, profit later. The Amazon model.
The Amazon model, but with physical atoms instead of books. They believe the AI efficiencies will kick in and widen the margins once they have density. But right now, gross margins are low.
So investors are essentially funding the construction of the machine, hoping that the machine prints money later. But until then, it's a cash furnace.
It is, and that creates the volatility.
Which brings us back to the price. We said the 52-week range is wild, from 93 cents to over $4.35. If you bought at the top, you are hurting right now.
Volatility is the price of admission for a stock like this. But there is a really curious data point about that volatility that I want to highlight. It's the beta.
Okay.
NextNRG has a beta of negative 0.57.
All right, hold on. For the listener who isn't staring at a terminal all day, what does a negative beta actually mean? Beta is just a measure of how much a stock moves with the market, right?
Correct. A beta of 1 means it moves exactly with the S&P 500. A high beta means it's extra volatile. But a negative beta means it has an inverse correlation. It suggests that this stock often moves in the opposite direction of the broader market.
So if the Dow crashes, the stock might actually go up. That seems counterintuitive.
It's possible. It's an anomaly. It implies that NextNRG doesn't trade on the same macro sentiment as, say, Apple or Google. It marches to the beat of its own drum.
Its own news cycle.
Exactly. When they announce a contract, it pops, regardless of what inflation data says. It makes it a potentially interesting hedge, a maverick stock. But it also highlights that this is a story stock. It trades on narrative and catalysts, not the general economy.
That's a really crucial discussion. You aren't buying the S&P here. You're buying the specific execution of this team. And speaking of execution, that's the other big risk, isn't it?
It is. Execution risk is high. We talked about that healthcare microgrid. Great headline. But now they have to build it. They have to maintain it. They have to ensure it works perfectly for 28 years.
Right.
Microgrids are complex engineering challenges. It involves permitting, construction, software integration. A million things can go wrong.
And if they screw it up?
If they stumble, if a project gets delayed, if the tech has a hiccup, the market will punish them severely. Because remember, they aren't paying you to wait.
Right. No dividend.
Zero. This is purely a capital appreciation play. If the stock doesn't go up, you get nothing. There is no quarterly check to cushion the blow. So we have the bull case. Skyrocketing growth, huge market, AI, tech. We have the bear case. Massive cash burn, execution headaches, no safety net. So if I'm looking at this today, what am I watching? What determines if this goes to $5 or zero? We need to look at the catalyst calendar. First thing to watch is the industry circuit. We're in Q1 2026, and this is prime time for energy and AI conferences.
Conferences can be catalysts. I usually think of those as just people eating stale pastries and handing out business cards.
Usually, yes. But for a small cap growth company like this, visibility is currency. NextNRG needs to be making noise. If they show up and unveil new partnerships or demonstrate their tech, that drives volume. It validates the AI part of their brand.
Okay, so we're watching the PR wire. What about contracts? We saw the January preliminary results. We need to see follow-ups.
We do. We need finalized confirmation. And more importantly, we need new announcements. That healthcare deal was the proof of concept. Now we need to see replication.
1 is a fluke, 2 is a trend.
Exactly. If they announce another PPA, maybe with a data center or a university or a logistics hub, that changes the narrative from they got lucky once to this is a scalable business model.
And then there's the big picture stuff, the macro.
Right. Keep an eye on sector rotation. We are seeing a lot of capital moving into renewables and AI energy. If the broader market continues to rotate funds into the sector, a rising tide could lift NextNRG.
Provided they don't trip over their own shoelaces. And finally, the financials, the cash burn. This is the part that scares me the most.
This is the scorecard.
Yeah.
Analysts are forecasting that in 2026, the losses should narrow to around negative 24 million. Remember, they're at negative 57 million now, so the street expects them to cut their losses in half this year.
That's the scaling thesis in action.
Exactly. If the next earnings report shows that loss number shrinking while revenue keeps growing, it proves the thesis. But if that loss number balloons, then the thesis is broken.
And the stock will likely retest those lows. Okay, let's wrap this up. We've covered a lot of ground.
Yeah.
Here's the lowdown. You are looking at a classic high-risk, high-reward setup. On one side, you have a company with triple-digit revenue growth, that 253%, and a potential upside of over 300% if they hit their targets.
It's an AI play in a critical sector.
On the flip side, you have a company that is burning cash, losing money on every share, and trading with the volatility of a cryptocurrency.
It is not for the faint of heart. You're betting that the transition to a decentralized grid is inevitable and that this specific company has the tech to run it. And that leads me to my final thought for you to chew on today. We often think of energy companies as just pipes and wires, or trucks delivering fuel. But I want you to ask yourself this: is NextNRG just a delivery service? Or are they actually building the operating system for the future power grid?
Because if they're just delivering gas, they're worth $1. But if they're the OS that connects solar, batteries, and the grid for hospitals and cities, then $5 might just be the beginning. The answer to that question determines everything.
It certainly does. It's going to be a fascinating year to watch.
That's the lowdown on NextNRG. Thanks for hanging out with us on the Easy Money Show. Don't forget to subscribe so you don't miss the next move. We'll see you next time.